Hey guys, welcome back. Welcome back. We are ready for our speaker today, Bryan Chavis. Though, so thank you for Bryan for making your time available. He's gonna speak about 5 phases of real estate investing: acquisition, implementation, stabilizing, which is pretty important, growth, and exit strategy. Bryan has spent the last 2 decades building successful real estate venture. He has a book like Buy It, Rent It, and Profit, and Landlord Entrepreneur, which is a guide for investor looking to build lasting wealth through multifamily real estate and property management. Bryan also launched the Multifamily Matrix, and his coaching program have become the global standard of consulting, coaching, and training for multifamily investors, landlord, asset manager, and property manager. Under Bryan leadership, company has developed to one of the industry most recognized property management certification, which has trained more than 50,000 investors to date. Quite an accomplishment in that. As an active investor and property manager, Bryan has also captivated audiences across country as in-demand speaker. So please welcome Bryan Chavis. Bryan.
Thanks for having me.
What's yours? Yeah.
All right. Got my guy Nathan here. Nate's going to kind of guide us through. If you're familiar with our podcast, then you're probably going to be very familiar with the way we present via Zoom. So Nathan's kind of the narrator, and we're going to take you guys through a presentation that I chose that kind of helps everyone understand those 5 phases: the acquisition, the implementation, stabilization, growth, and exit strategy. Probably will not have enough time to go through every single slide, so a few of them I've just selected to show you guys some bullet points. We'll keep it moving to where we can kind of focus on some of the fundamentals and the foundations that I feel like when I was given the demographics and psychographics of this group, I kind of felt like what would be more impactful in the 30 minutes. How can I provide the most value to you all within these 45 minutes. And so this is what I've chosen. So hopefully you guys like it as much as we like presenting it. So feel free, you have questions, we're going to do Q&A at the end. So with that being said, I'm going to let Nate drive and dive in. Let's go.
All right. Excuse me. So thank you guys for joining us this Saturday morning. If you guys are in California, Saturday afternoon, if you're following us from the East Coast. And today we're going to be doing our apartment investing masterclass, multi-million-dollar apartment investing fundamentals. And so real quick, just what you guys are going to learn in this discussion. You guys are going to learn how to create what's called an apartment syndication, how to set up proper entities to buy apartment buildings, how to create things such as private placements, how to structure your fees, how and where to raise money for apartments to invest in, where to find investors. We've got a long list of things. I won't go down the list, but we've got a lot tucked into this discussion. And so let's get into the basics of this. So there's what's called an apartment syndication. And so, anytime you plan on taking investors' money where there's returns generated primarily from your efforts, it's called a security, but it's also, we call it a apartment syndication. Tell me more about what that is. What is an apartment syndication?
Yeah, I think you nailed it right on the head. The key is in understanding is when you raise money outside yourself, friends and family, you begin to get into that securities law, and you need to bring in the proper experts,
right,
and the proper structures.
And so you're saying that you can actually invest in apartments without using your own money. So that's
essentially,
okay.
Yes, correct.
Okay.
That is correct. Absolutely.
Nice. I know a lot of people, they want to, put their own capital in, but there's other ways. So think about that as you're moving forward on your investing journey. And so when you're looking to raise money, there's a couple of questions you want to ask yourself. Are you purchasing a specific property, or are you putting together a blind fund? Why are we looking at those two questions? Why should we be thinking about that?
Well, these are general questions that you ask yourself as the syndicator or the general partner.
Okay.
Kind of helps you guide the ship moving forward, building out that framework for the model for the business. So you got to think you're starting, right? Most of our group is in the California area, so they're very familiar with startups.
Got it.
And this is the basic foundation of pretty much all whether we're talking multifamily or
Right.
a small business, this is the foundation of building a fund or startup.
Perfect. Thank you for breaking that down. And then, so within, once again, we buy an individual property or we're starting a blind fund to buy multiple assets. There's a couple of exemptions. So we've got, there's actually several exemptions. So, but most commonly used, we've got things like 506B, 506C. You've heard of these when you hear people talking about investments. 506B, if you have pre-existing relationships, and then I believe 506C is the use of advertising. So tell me more about that.
Again, and that's exactly right. So what you see is more common for those who are on social media. You see the Grant Cardone is the C. Some of the others that you don't see that that kind of put together syndications or do well. They're most likely a B, so they're not advertising.
Got it. So you can set up a B if you have pre-existing relationships, you have a bunch of people of influence. Right. And then if you're looking to advertise to the general public, we're going with something like a C.
Like a C, right. If you're looking to do what we did, you're going with the C, like Chavis Capital. We wanted to be out front. We wanted to advertise. So we chose the C selection.
That's excellent. So once you've decided on, the exemption, you're going to want to focus on creating what's called a PPM. Can you explain what a PPM is? Was private placement memorandum? What is this?
So it's about a 200, 300 page document that tells you why you should not invest with the investment group. Basically, in a nutshell, so it gives 101 reasons why you probably should stay away from real estate.
Right.
So it's that document that everyone should read, but no one ever does. The fine print of like, this is the risk of real estate. This is a risk if the risk involved with the with this asset or this strategy. So again, the private placement is just kind of it lets the individual understand what he or she is getting into.
So what?
Very important document.
I mean, I'm just asked this question. So isn't real estate like supposed to be the sure thing? Why are we talking about losing money? Is that not necessarily a sure thing, huh?
Yeah, I wish. Okay. Yeah. I mean, and it's funny because if there's going to be a sure thing, and this is, to stay on topic, but if there's going to be a sure thing, it's usually real estate.
Got it.
Because there's tons of operators that can hide a ton of mistakes through real estate because of the ability for it to appreciate, or why people love multifamily, the ability to hide the mistakes and the economies of scale and the larger deals.
Right.
So you can be a subpar operator and still do well because the market carries you.
And so think about this as an individual, or if you're looking to raise money. So don't just think about, oh, how can I raise money? This is too overwhelming. If you're looking at a property for yourself, you want to be looking at, okay, what could go wrong? And in this lecture, in your training, you said there's kind of two key areas that will also paint the picture of how you're going to succeed. One is your business and property management plans. Correct. And the other one is your property management and your asset management abilities.
So that's the second part of the PPM. So the first talks about the risk. Second is very important. It begins to lay the foundation of this is so risky, but this is why we mitigate some of the risks. This is who we are.
Right.
And this is where you begin to show. But this subsequently, really important, really, really quickly.
Yeah.
This is where, if you really look at most operators, this is where the winning and the losing happens, because most operators really don't have extensive plans on operations, the business and the management plans and the management plans of each property. And we'll get into that as we go through this presentation. But yes, this is where you begin. If you do read the fine print, you can really start seeing who is a newly minted operator or someone who's well seasoned and has the operations, down pat, because this is where they usually begin to show those, to open up, like this is how we actually operate the particular properties or the portfolio.
Got it. Yeah. Thank you so much for breaking that down. And so we are going to get into the 5 phases. Let's start with laying the foundation of this syndication. We're looking to raise money. Now we have what's called a limited partner. Who is the limited partner in this? What is this?
Yeah. So your limited partners are typically for, let's, keep it within the context of our listeners, viewers, since we're on Zoom as well. But keeping it in context, is these are individuals that you're looking to raise money with.
Okay.
So your silent partners, could be, again, friends, depending on what selection, could be friends, family, other businesses, institutions. We'll get more into that. But as a limited partner, these are the individuals that are looking for a return, a passive income, And as the general partner, you're the individual that's, saying, hey, look, I'll put all this together,
Right.
and I will execute on it. And I will offer you a return for your investment of X, Y, or Z.
Wow. And I'm starting to already, the wheels in my head are turning. This is why showing property management, asset management knowledge is so important. As you're looking for people to give you money, you're showing them capability of being able to manage the asset. And so let's move into the general partner. What is the general partner? So we got the limited partner. What is the general partner?
Yeah, the general partner is the quarterback.
Okay.
This is the managing and operating entity.
Yeah.
So, in that PPM, in that private placement memorandum, again, here's the risk and here's how we mitigate the risk. This
Right.
is the individual that has put the systems and the model in place, the framework in place to
Right.
mitigate that risk, whether it be through management plan, asset management, property management, day-to-day operations.
Right.
This is the general partners handling and operating the location, the acquisition, the implementation, stabilization, growth, and the exit strategy.
Wow. And so it says here limited capital investment, sometimes 0 to 10%.
Correct.
So 0%, and you're earning through sweat equity. So what are some of the things that you're doing?
Right. And the key here is, can you can you buy a 50-unit apartment building without putting your own money in? Absolutely. I've done it several times.
Right.
But the difference is, what are you bringing to the table?
Right.
So are you bringing equity to the table, which is important, but more important, who's bringing the knowledge, who's bringing the framework, to be able to execute on Monday after you've closed on Sunday, on Monday you close, on Tuesday you've got somebody's got to show up and operate. Typically, when you're talking multifamily discussions, it's always handed to a third party property manager.
Right.
Obviously we know that that's not our philosophy. You even if you hand it off to a third party property manager, you as the general partner or the GP of the syndication should have already created a management plan to hand over to that property manager.
Right.
And that usually typically doesn't happen. To hand over a management plan, you have to understand management. You have to understand, and we'll talk about that, but you have to understand what goes into a management plan, the framework of a management plan. Then you hand that off to a property manager. So the responsibility of the general partner, there's an enormous amount of responsibility to build out this framework.
Of course.
And then this is the individual that's coming to the table with the framework. And typically when you come to the table with the framework in order, a model, then you have the ability to say, okay, this is what I'm bringing to the table, then seek equity without having to put any your own sweat or your own capital or equity into the project.
I love it. This is sounding exciting as you grow your investments and you are becoming a practitioner. Other people are going to see you, and you have the ability to get them to put their money in based on your expertise. So as we were in the breakout room with a couple of new investors, they're thinking about possibly long-term or short-term rentals. Once they acquire those properties, other people are going to want to follow suit. And so they're ahead of the curve. They can, start doing syndications and things of that nature. So no, this is really exciting as this all kind of unfolds.
To an extent.
To an extent, yeah.
At the end of the day, it's about being able to prove that you can execute.
Correct.
And executing a few duplexes and single family rentals and a couple of Airbnbs is not necessarily a guarantee that you can bring the proper framework necessary to operate so it's important. Important to understand to a certain level. I understand there's tons of individuals out there that have large amounts of rental properties and may even have a few apartment buildings, but are horrible operators.
Got it.
And it's very difficult for them to mimic what they do consistently throughout various different markets.
That's true.
Without a strong operational background, asset management background, property management background. Even though they may be successful in their own market and have tons of rental properties, doesn't necessarily mean they're going to be a successful operator. So the education and understanding how to build out that framework and build that model is really important. The general partner model is really important.
Excellent. Now, thank you for breaking that down. And so as you guys listen, continue to think like, okay, this does take a lot of knowledge, a lot of information to execute. So let's move on to how do we get paid as a general partner? So we've put together this syndication.
$1 million question.
I love it. I love it. So we got this general partnership. How do we get paid? It looks like there's a variety of ways that we can make money as the partner, sweat equity.
Correct. Exactly. And you'll want to put this fee structure in place, and the fees are usually laid out in the private placement memorandum as well as the operating agreement. We'll get to the operating agreement soon. But yeah, you get paid through an acquisition fee, equity raise fee, property management fees, construction fees, disposition
Okay.
fee. So when the property is sold, there's a fee paid to the general partners. These are the ways, the fee structures that usually generate, keep the lights on,
Right.
pays for the rent at your office building. This is where you bring in the income
Okay.
up front. So
Love it. Love it. And then so there's now something called a promote and a waterfall structure. Tell me more about that. What does that mean? Promote and waterfall structure.
yeah, so waterfall structure is really how, again, this is where the general partner, this is how you get paid.
Okay.
So the waterfall structure is, you're offering a return to an
Okay.
investor, right? You say, hey, listen, if I buy this apartment building, I'm going to offer a 6 to 7% return.
Yeah.
Let's just say a 6% return.
Right.
Making, I think somewhere in the presentation it says 8 or 7,
Yeah,
but
yeah.
More realistically, now returns are
Of
getting
course.
a little bit, those margins are getting a little bit more, they're narrowing by the minute because of
Right.
values. But well, another topic. So you say, yeah, I'm going to offer you 6%, Nathan. I'm going to buy a 100-unit apartment building. I'm going to offer you 6% return. How do I get paid if I'm offering you 6% return?
Yeah.
Well, as a general partner, and again, this is where really being solid on execution, and understanding how to guarantee your profits.
Yep.
As an operator, I probably feel like I can probably get, maybe an 8 to 9% return.
Okay.
I'm offering you a 6% return. I give you a solid return, 6-7% return. Anything above that pref, then we split, in a one-tier waterfall structure, we may split, 60-40.
Yep.
60 to me, 40 to the general partner. I'm sorry, to the limited partner. And this is again where, and this is just a tier one type of,
Right.
there's tons of ways to be able to kind of divide, the back end up on a waterfall structure through various different type of hurdles one needs to meet as the general partner. And then, agreements on how that individual gets paid. But a tier one structure is, hey, listen, if I get you your 7% or
Right.
6% return, anything above that 6%, we split 60-40.
Okay.
60 to me, 40 to you. That's a tier one.
I'm loving it. I mean, it sounds like there's just continuous ways to earn income through this thing.
Correct.
To get paid. So now let's go back to setting up the entity formation. So once again, we talked about the different types of entities. Tell me more about setting up an entity for a syndication, and
Yeah. So
what do you
the
want to think about?
the acquisition framework is what we're talking about
Okay.
right now. So we're still in the acquisition mode. So the framework is, if you identify the property, you're ready to kind of pull the trigger on a
Okay.
few properties, you may create a single purpose entity.
Okay.
Which is known as an SPE, a single purpose entity. Sometimes you might put projects under contract. Of course, you have a letter of intent, which is
Right.
not a binding contract. But if you like the deal after due diligence, you move into a sales and purchase agreement
Right.
contract, which is a binding.
Okay.
At that time, typically a lot of folks will go into contract or enter into a contract and then switch it out to the single purpose entity.
Right.
They may even have that upfront specified to the seller.
Okay.
That this contract is subject to assignment to our single purpose entity.
Right. Okay.
So they may operate it or control it through some sort of umbrella corporation. Initially put it under contract, and then once it's under contract, within that contract period time, or due diligence time, they may move it to the single purpose entity.
Okay. I'm here to ask the stupid questions. So I want to ask, why are we setting this up as an LLC versus just like buying this property and as
In
like
your own name?
Yeah, in my own name.
Well, and it's funny that you mentioned that, because even if you buy it in an LLC,
Yeah.
a lot of folks think that, oh yeah, I've done what I've read or heard in a boot camp. You can still buy it in an LLC and still be viewed as a sole proprietor.
Got it.
So if you buy it in an LLC, but yet you take that debit card and you buy personal items, or you go to Vegas and you're buying, and you find yourself one day on the witness stand, the creditor is going to say, well, hey, listen, they're going to pull the transactions of this business. What they're trying to do is prove that what you really have is a sole proprietorship and not a corporation. Because typically you're going to, obviously 100% of the time, you're going to try to stand behind that corporate veil.
Right.
the creditor is going to try to, their job is to pierce that corporate veil.
Right.
The best way to do that is for me to prove that you really don't have a corporation, that you're a sole proprietor, you're acting as an individual. And the best way to do that is for me to pull your records, your bank records.
Okay.
So if you're signing, go to Home Depot to open up that business account, but you sign in your name, but not as an assignee of that corporation,
Right.
or you have a debit card and you're out there purchasing things outside that look like an individual, maybe shoes. Oh man, I'm at Target. I know the kids need to go back to school.
Right.
Oh, I don't have my personal wallet on me or my money. Let me just use my business card to buy the kids uniforms before they go back to school, whatever it may be. These are things that a creditor is going to say, well, these are the actions of an individual, not the actions of a corporation.
Right.
So a lot of individuals, will get caught up. So I'd rather focus on that, because a lot of folks know why you don't put real estate. That's like real estate 101. You can read that, Real Estate for Dummies, and figure out why you don't put things in your own name, right?
Yeah.
And then, you get into that. Well, the bank may have a trouble with switching it because it's going to do on clause sale if you try to switch the name. But there's been tons of individuals that have talked to individuals about that.
Right.
I want to kind of focus on, when you get to this level, even if you do it right, you can still find yourself in trouble, because I would say 90% of the people are not doing their corporate minutes. So then the second thing, what's going to happen, the creditor is going to ask the judge, well, can they provide the corporate minute book for this corporation?
Right.
You can't go back then and go and take a recess and write out, 3 years of, corporate minutes, or 3 months of corporate minutes, and then hand that in.
Exactly.
So they're going to want to see that. So if you have an LLC, but you haven't been doing your corporate minutes or the maintenance, every state's a little different, but it's about an 80-20 rule. 80% of it's all the same, right?
Yep.
So, but if you haven't been doing those minutes, and you haven't been maintaining the maintenance on that LLC, that's what the creditor is looking for. Well, Your Honor, look at the bank statements.
Yep.
They act as an individual. They haven't done their corporate minute books. They haven't maintained that.
Right.
And according to our state law, these are the requirements, the maintenance that's required, right? Yep. To maintain the LLC. And so what they're going to do, Nate, at the end of the day, is try to prove on the stand that you don't have an LLC.
Wow.
You're an individual acting as a corporation.
Wow.
And so now what they're going to do is come after you personally. And then you might even say, okay, well, me and my wife both do real estate. All right. Me and my wife's hip to what I'm doing. So let's keep everything out of her name, so they can't go after us. Yeah. Or what happens more commonly is the creditor is smart, because if you're smart as the person being sued, as the plaintiff, you'll probably own stuff you like, various different ways. Yep. Hopefully, maybe joint tenants in common with your wife, right? Then the only creditor you got to worry about is your actual wife. So, the only thing you got to worry about is making sure that you chose the right spouse.
Yep.
That's a different conversation. But at this point now, that's protected. But if your name appears anywhere else, let's assume that, like you taking care of your mother.
Yeah.
Right. So you have a bank account. Mom has a retirement plan. You kind of handle all of the paying of bills for mom, because she's getting up there in age. She's in a retirement home. You're taking care of everything. If your name appears on that, even though she's the main, but you are on the account, so you can pay bills for her and make everything easier, make life, because you can hit one click of a button and everything is auto paid. But to allow you to do that, your name has to appear on there as an assignee. If your name appears on that account, mom's got $100,000 from her retirement, and that's how she lives, the creditor can come after that anywhere your name appears. That's why, when we get into this presentation, why you set up a different property management company. If you're an operator and you just bought yourself a 10-unit apartment building or duplex, make sure you create a different LLC to do your property management out of, and then create the bank accounts, keep them separate from the single purpose entity, because anywhere those signatures appear together, the creditor says, nope, that's a partnership. And then they can come after that income in that particular business and pierce that corporate veil. That's why you have to have all the contracts, even if you're one person, where you got to create an LLC, put a property manager hat on, sign a document, a management agreement between you and that single purpose entity, even though you're the owner, right? Take the hat off, put the owner on, sign there. You got to have a paper trail showing that it's all separate. Wow. Because there will be a day when you're on that stand where someone's going to sue you. There's always a slip and fall, or a fair housing, which is a, different topic and different, presentation. But, if you've been doing this long enough, you understand that, it's not about when or if you're going to ever get sued. It's more when are you going to get sued.
Yeah, absolutely. I wanted to ask that question. We're talking to the San Francisco multifamily and more. And so, I think high net worth, access to capital, things of that nature, and you can easily get yourself into trouble. So we want to make sure that all our listeners are protected. This is a huge foundation, as we're looking to acquire properties. So making sure that your entity is set up properly. And so
Yes.
let's move on. So now we've structured our entity. Let's talk about the operating agreement, the JV, joint venture operating agreement. What is this?
Right. So now we're confident that we got all of our,
Right.
our corporate structure, right? So now, this is where you go into an agreement between you and your partners.
Okay.
And this basically tells you the rules of the game,
Mm.
rules of engagement. Who gets paid, how you get paid. If something goes wrong, this is what happens. Who's in charge of operations? How are you going to handle operations?
Okay.
And this is where a lot of folks, this is where a lot gets, as a one-page document.
Right.
If I'm going in a partnership with you, Nathan,
Yep.
and you're the operator, and I know nothing about it, I'm a limited partner, I'm going to really want to see your framework on how your asset management, how are you going to handle, if you're going to hire a third-party property manager, how are you going to make sure that third-party property manager is in alignment with our goal structure, our waterfall structure.
Absolutely.
Everything depends on that waterfall structure. How many, and this is a question for all of our listeners and viewers. Ask yourself how many individuals or investors that have a property right now that can produce a full management plan. Okay. Ask yourself how many investors or friends you have right now. If you ask them to produce, whether they're a single operator or they're in a partnership or a syndication, can they produce a management plan? Don't tell me that, no, we have someone else, third party, managing that property. Is there a management plan that you've created and then handed to that third party property management company to ensure that your waterfall structure and ensure that fees are the property is going to be run and maintained, to ensure that what you have in your original JV and private placement or investor deck that you sold me on, are you just relying on the market to carry you, which most are. If they can't produce a management plan, I don't care how much they say they have an experience, Nathan, they're relying on the market to carry them. If they can't produce a management plan, you're relying on the market. You're not relying on your fundamentals. And it's okay to have the market carry you. It's okay to have the market carry you. But in case when you're raising other people's money, you want to always know that you can rely on fundamentals. If all hell breaks loose, if a COVID happens, whoever thought of COVID a year ago, if something happens, can you guide the ship? And you're going to see, with the memorandum moratorium wearing off, the eviction moratorium wearing off, you're going to see more operators. You're going to see those who are swimming naked.
Right.
You're going to see those who are really swimming naked, that they have no idea about operations, that they're leaning solely on the third-party property management company to guide them out or give them guidance. But wait a minute, if I'm a limited partner, I handed you $200,000, $500,000. I entrusted you. I ain't trust a third-party property manager. If that's the case, I would have just handed my $500,000 to the property manager. They seem to be the ones that know what's going on and the ones who's operating it. Who are you? You are the face, and you can't raise people's money and bank on the market carrying. And that's what I'm gonna be honest with you. I would say 70 to 80% of what you see out in this market, that's what you see. If they can't produce a management plan, they can't produce some sort of framework or a detailed management plan for each property, not overarching, but each property. If they can't produce that in 48 hours, I question whether or not, again, are they operators? Are they dependent on the market?
Wow. Okay. Let's you're freaking me out, B. Let's talk about how can I make some money, man. So let paint a pretty picture for me. So fee structures. Let's talk a little bit more about some of the realistic fees and percentages that we could make within these types of syndications.
Absolutely. And and I'm hopefully we're not, I know that was a bit scary,
It's just conversation.
but at the end of the day, it's like if you want to if you got up this morning in San Francisco and you wanted to understand this business, do you want it? I can paint you a fluffy picture. I mean, you can go to any boot camp and read any book and how to get rich in real estate, and that's what they're going to sell you. But these are the fundamentals and the skill sets that true successful operators, you understand that this is a science.
Exactly.
We're not playing checkers. This is chess. And so it's important that individuals know that this is a business and it should be treated and respected as such. And when you can do that, then you can start talking about fee structures and understand how you get paid.
Absolutely. 100%. We do this on a weekly basis, and it's serious. You guys want to make sure that you're, dotting your I's, crossing your T's, and, we don't want to gloss over that.
Correct.
So B, thank you for breaking that down. Let's talk about fee structures and how do we get paid, more so on a granular level. Let's look at those.
The percentages.
Yeah, let's look at
Okay, don't just tell me I can charge a fee. What can I charge? Can I charge 20, 30%? No.
Yep.
Typically, when you do an acquisition fee, you're in between 1 to 2%, Nate.
Okay.
Construction management fee is in between 4 to 7, depending on how much rehab needs to be done. And for me, there's construction. I like to take the word construction out. I like to call a rehab fee or a value add fee.
Yeah.
Because construction or adding value may come through construction.
True.
Hammers, nails, saws.
Yep.
Or it can come through like what I'm more commonly known for is turning the property around through operations and systems.
Right.
And removing certain tenant demographic and replacing it. Right. So that could be, that can also be, there's a fee that you charge. So if you put construction, you kind of kill yourself on that. But if you put value add, management fee, or you change the wording, then you can add more to that process. But then you have an asset management fee, which is anywhere between 1 to 2%.
Okay.
That's the fee you're charging to if you have third party property management, or even if you have in-house property management, you still got to maintain and operate your team. So that's where that fee comes in. It's based off the effective gross income, and then a disposition fee between 0.5% and 1% of the sales price.
Excellent. Oh man, so the money is now rolling in. So understanding promoted interest, we did talk about that a little bit, but you want to dive into that a little bit more?
Yeah. So I mean that in a nutshell, that's how a general partner really gets paid,
right,
through the promoted interest.
Okay.
And so this is to say something different on this slide that they haven't heard. This is where how do you ensure that? This is how you ensure it. How do you fix the board, so to say,
right,
through your COTA process, strategic evaluation of a target area. We'll talk about that. Yep. Studying the area, understanding demographics and psychographics of your prospect tenant. When you can do that, most people talk about, Nate, investments and deals and underwriting and brick and mortar.
Right.
But as long as I've been in the rental business, 20 some plus years, over 2 decades, I've never had a building pay me rent. People pay rent. So the multifamily is not about brick and mortar. Development is more so. Multifamily investing is more so about understanding who your prospect tenant demographics and psychographics are, and learning how to skate where you think the puck is going. Not skating to where the puck is, but where you think the puck is going.
I love it. So I want to talk about the waterfall structure in detail, and then let's get into some of the understanding markets, the 5 phases. So once again, we talked about promote. Now we're talking about the waterfall structure in detail. What are we looking at? As far as paying out limited partners.
Yeah, so it's that example says it in H really easy. So an example is if you offer a 20% promote, which you're not doing these days, but if you you may, if you have a 20% promote over a 7% cash on cash return,
right,
which is feasible in this market. 35% promote maybe over 14%. So in this particular document, the general partner saying, hey, listen, I'm gonna offer you 7%. But if I get you anything over 7, I get you. I get a 20% catch up or 20% promoted interest.
Right.
So I receive 20%. So 80, 20, 20, 80 to you, 20 to me. If I get you 35%, 14 to me, I'm sorry, 35% to me, if I get you 7%, if I get you 14%, it's 35 versus 20%
Right.
on the catch up or the promoted interest. So obviously the more, the better I do, the greater the returns are for the general partner.
Right.
Now the limited partner still is getting paid handsomely, but this is where the general partner really begins to make their money through operations.
Got it.
So the better you do, the greater your returns.
Got it.
Depending on your structure.
So using we have what's called an investment memorandum. Real quick, why don't you explain what an investment memorandum is, as you now identified the property that you're looking to invest in?
Right.
Tell us that, and then we want to talk about where do we find investors? Where do we find people to invest in these properties?
So this is more commonly known as maybe an investor deck.
Okay.
So this is the glossy,
yeah,
marketing pack. This is where you excel, putting the company in the best light. This where do you invest? What's your strategy? What's the minimum requirements? What's the timing of the capital raise? This is the fun marketing stuff that everybody likes. So that's kind of what you're putting in. So really the investor deck should really talk for us. It's all about strategy and understanding that we're the masters of operation.
Right.
How do we come across, really highlighting to our limited partners that, giving them confidence that we're the best at operations. So this is where you have an opportunity to really do the nice glossy work where, you explain what your vision is, how you're going to go about, what's the framework to go about making sure that vision comes to you can execute on that vision. So that's really what the memorandum is about: financial forecasts, investment rationale, risk mitigates, market information, fee structures, capital timing, and things of that nature.
Got it. No, thank you for breaking that down. And then, so one way that we find partners is by sharing our investment memo, our investor deck with folks. And then looking at things like large institutions, your professional network.
Yeah.
Go ahead.
The main thing is going to be, Nate, this day and age, it's really about, to be honest with you, it's less about investments and what markets you're in. Yeah. And it's really more about how people perceive you, the individual, how comfortable are they with you.
Right.
So, that to me, people really don't necessarily invest in the deal. They usually invest in you as the individual. So making sure that, you see this nowadays.
Yeah.
And we'll, and again, we'll just try to keep it real for the 30 minutes we're talking. So, whether you're new to this or you've been seasoned, you'll kind of understand and fall in with your understanding where you need to fall in. But if you watch and you look on social media and you listen to podcasts, it all sounds the same these days.
Right.
It's you can go from one podcast to the other. Everybody's talking about the same thing. Might even have the same guest.
Yeah.
Everybody's talking about how to raise money. Now you start to see people trying to switch and get into asset management, but it's like you kind of tell the level of depth of asset management is minimal with the conversations and the topics, but you got to be able to say something different. You have to be able to attract individuals to your brand and who you are. And it's hard these days because everybody's saying the same things. Right. There was a book called, I believe it was called Blue Ocean, where it talked about being different, getting above the white noise. And right now you hear a ton of white noise. It's all the same thing. Everybody wants to talk about being a spreadsheet jockey and underwriting and markets, how to raise money and things of that nature. But no one really wants to peel back the layer of the onion, lift the hood up and talk about operations. Right. Just hand it off to a third party property manager. You'll be fine. You'll make tons of money in real estate.
Wow.
So it's just, to in order to attract individuals to you, my suggestion would be, master these 5 phases: acquisition, implementation, stabilization, growth, and exit strategy. If you can master that and you can articulate yourself, you get it to a point where you can articulate, they'll find you. You don't really have to stress about where the money is. The money will find. Money has a funny way of finding skills. Money, and you can see this in sports.
Right. You
see now the diversity in the leagues, right? Basketball, they're finding guys in the Ukraine and in various parts of the country. Although, look, I can't pronounce his name, but look at our man, the Greek Freak. Yep. You didn't see this. When I was playing, you didn't see that. You had to go play, overseas, and you might see some. But now you see everybody. Why? Because money will find talent. Now there's systems in place to find talent. You can be in the remote part of the world, right, and they will find you if you have the skills. So I'll say, for all of those who are taking notes, maybe hopefully people are saying enough where folks are taking notes, but for every listener, the most important thing you need to know about investing in real estate is getting the skill set down and then being able to convey those skill sets to others. The money will find you. If you're stressed about trying to raise money, don't. That's the problem, is you're stressed about trying to find money. And you're focusing on trying to find money and raise money, but you haven't focused on the fundamentals. You can focus on the fundamentals and half-ass relay that to others with some sort of confidence. The money will find you. I promise you. I will guarantee the opportunities and the money will find you when you develop that skill set. So stop thinking about the money and the raise and think more so, how do I develop my skill sets? How do I build the foundation? Because once you have that, right, they can't take it away from you. And I'll say this, and we'll move forward quickly for the sake of time. Look at me as the example, because some people might like, yeah, that makes sense. Well, if it makes sense, but let me put it to context. Here's a 40 plus Black man with a high school education, no college degree, special education, graduated with a special education degree, right? Meaning learning disability, graduated with a learning disability diploma. Here's a man who suffered a brain tumor, who lost his ability to walk and talk and had to, at the height of his powers, had to start over and reboot. All of what I've had to encounter in my lifetime, I was able to continue moving forward and do what we're doing today and attract some of the greatest talent to our team with Chavis Capital, do some of the greatest things that I've done, put books. We failed to mention this in the beginning, so I'll toot my own horn for a minute. I did not just write books. I published through Simon & Schuster. Anybody writes books these days and put them on Amazon. Everybody's an author these days, but you can't say, hey, look, you can go in any library, any airport in the country, you can find Bryan Chavis. You can go to the U.S. Library of Congress and find Buy It, Rent It, Profit from somebody who started out with a high school diploma, special education, who has suffered probably more loss than anybody on this call and had to redo it again and relied on some principles, my faith. Second, my ability that no matter what they did up here to my brain and how much they removed, they didn't remove the part that understood how to manage and operate real estate. Right. And so I was able to rebuild. It's the skill sets is what I'm trying to tell you guys. So I'm not telling you something that I've heard. I'm telling you something that I know. It's the skill sets. That was one thing that's the common denominator in everything of who I am, is these skill sets. And look what I've been able to do. So if I can do it.
That makes sense. No, okay. I'll stop asking about money. I want some skills. So let's talk about markets, man. So understanding the CIOTA process. What is the CIOTA process? What do you consider this to be?
Yeah, so this is what I coined. I was doing CNBC Money when Buy It, Rent It, Profit first came out, and you only have a couple of minutes to do Buy It, Rent It, or a segment on CNBC on the money, if that's even a segment anymore. But so I had to come up with something. So I came up with the CIOTA, Strategic Evaluation of a Target Areas. Okay. Before the book came out, I was promoting the book. Before the book came out, Strategic Evaluation of a Target Area is what I was taught in the multifamily industry. That's my background, the apartment industry, Okay. So this is how we were taught to find markets. Okay. Not find investment deals, but to find markets. So studying population growth, job growth numbers, rental demographics and psychographics. Demographics tells you who your prospect tenant is. Psychographics tells you the why. Okay. Huge difference. path of progress to target markets. Political climate,
Okay.
really important. So these are the things that we're studying in the COTA process.
Got it.
Identifying markets.
Identifying markets.
Right. And if you're taking notes, skating to where I think the puck is going.
Okay.
You're an idiot if you think that this means I'm just identifying markets to what the market is doing today.
Right.
Any idiot can identify a market when it's hot today. And, Stevie Wonder can see hot markets today. It's about skating to the puck where you think the market's going. For example, buying Park Plaza, 2.6, selling it yesterday, putting it on the market for 4.6.
Right.
Skating where I think the puck is going.
Got it. And so that's, so we got the overall market, looking at the COTA process. Now we break it down to like regions and neighborhoods. What are we looking at within regions and neighborhoods? Why are we starting to analyze these?
Right. Again, transportation, amenities, employment, major schools, and these are the things you're getting more granular.
Why am I not just looking at what like rent could do?
Well, because rent is affected by employment.
Okay.
So you got to always, you always get to the root.
Okay.
You always get to the root. And again, with real estate, everyone sells. You see the apple tree.
Yep.
But you got to get to the root. You can't just, you got to get to the bottom of where that,
right.
And then you're able to forecast. When things like COVID happens, you're able to make predictions on who's going to be affected more.
Right.
What income class is going to be affected more. And when you identify what income class is affected more, then I can identify what asset classes are going to be in trouble.
Right.
Hence, why I'm saying strategy wise, I'm looking for units between 20 and 80, anything under 100 units, and nothing less than 20 units is why I'm looking. Am I an institutional investor? Absolutely. Do I want the 200 units? Absolutely. But I know that most of these guys are not going to touch that because it takes a certain skill set to operate these smaller asset types.
Okay.
Because you can hide mistakes in critical mass more on the economies of scale. An example, if you got a single family home and I got a duplex, you got a vacancy, I got a vacancy. What's your vacancy rate?
If I have a single family home?
Right.
That's 100%.
There you go. And I'm 50%. I just shaved my risk by owning one more unit than you. Right. So you can hide a lot of risk the more units you have, the critical mass. That's why you see a lot of these syndicators begin to talk about, we only look at 200-300 unit, institutional level, because if you're a poor operator, absolutely that's what you want to lean towards. Right. Because you can hide more mistakes there. But you can't hide mistakes if you're an operator of a 20 unit, a 30 unit, a 40 unit, an 80 unit apartment complex. You're kind of exposed. Piss poor operations there can't be hidden.
No.
So understanding what COVID has done, understanding where the eviction moratorium and the effects of this, not to where what's happening today, but getting to where I think the puck is going, I see a lot of these individuals in trouble.
Right.
So I'd rather string together a bunch of 40 to 60 units to get to my critical mass. Does it take more in operations? Absolutely. Does it take more skill set? Absolutely. But this will weed out a lot of individuals to where we're able to find and execute on more deals. Does that make sense?
That makes perfect sense. So a little bit of vocabulary here. So we got things like the LOI. Once we've now looked at the COTA process, we've kind of found a place that we want to invest in. What is an LOI? What are we doing with this?
Letter of intent. We talked about that.
Okay.
It's an agreement. But it's non-binding. It's not a contract.
Got it. And then what about like PSA? So what's PSA?
Contract. So now you're talking about legal. Yeah. So when you get to this point, it's for all the marbles.
Got it. And let's get into, so now we're starting to analyze the deal. We put the LOI out. Let's look at things like cap rate. So what is a cap rate?
Yeah. Cap rate is giving you an idea of value.
Okay.
And I say an idea of value because cap rate is the net operating income for that year one divided by the purchase price.
Okay.
Well, the purchase price is up for debate. So therefore a cap rate could always be up for debate. Usually a cap rate is based upon what sales have happened in the region. But again, original sales or sales is based on what I think. Like right now I'm selling something. It's based on really what I think. Is it based on like I'm aggressive right now with this downtown property. Why? Because I feel like it's really, I'm catering to a developer to put a high rise on this lot. Blocks from the water, downtown St. Pete, can put a 20-story building there. Right. So for me, I'm evaluating it, based on, again, skating to where I think the puck is going. So it's my interpretation of value.
Got it. Thank you for breaking that down. And then
And the lower the cap, as you can see in the slide, the lower the cap, the higher the value.
Higher the value. Got it.
So don't buy Park Plaza if you're not willing to pay 152 for a cap.
What about cash on cash return? So you guys will be seeing these as people are presenting deals to you, as you're looking at deals, cash on cash return.
Your return on the money that you put into the project.
Okay.
From a cash standpoint, a dollar standpoint.
Got it. What about the internal rate of return? You hear people say IRR.
Man, you hear that a lot, don't you?
Sounds official.
I mean, how many people really know what that is?
I don't know.
I don't know the number of how many people really know what it is, or I don't know what IRR is.
I just hang out with you.
You know what it is. But anyway, so let's explain IRR for a moment. Please. Because a lot of people, once again, they'll skip this because this is, and granted, I'm a high school graduate, so I don't have a degree in finance, real estate finance, but I have plenty of people who work for me with degrees in finance. So probably more degrees than a thermometer, but let's explain it. So it's important that you understand that IRR in layman's terms measures the efficiency from which you get your money back.
Okay.
The efficiency. So I can have, Nate, I can have deals.
Yeah.
And you have to be in a group raising money, and you got a doctor, an attorney, you got another serial entrepreneur, and everybody's got an idea of a discount rate. Remember that, write that down. Everybody's got a discount rate. Most people call it an opportunity cost, opportunity rate.
Right.
It's basically, well, the doctor says I can invest in this mutual fund and get this.
Right.
Let's say 5%. That's his discount rate.
Right.
The serial entrepreneur says I can buy a bowling alley and I can get a 9% return. That's his discount rate.
Okay.
And so on and so forth. So everybody might have a different discount rate. Right. Just keep that in mind.
Yep.
So when you're punching in your numbers and you're looking at various different things, you're going to understand that you typically have cash on cash return, you have an equity multiple, and you have an IRR. Most of these models that everyone sells and boot camps that everybody goes to, the model has this, but really, does anyone explain it?
Right.
So cash on cash return is great. That gives me an idea of cash on cash return, right? But it doesn't necessarily give me an idea, and you can have a cash multiple, right? That says, hey, listen, if I give you $1,000, I'm going to give you back double that. How many, by a show of hands, if I told you I can double or triple your money, you would think that's a great move? Just nod your head because I can see some of you. If I told you I can triple your money, most of you, would you think that's a good idea just by a show of hands, or just nod for those who are on camera?
Not in my head.
Right?
I want my money double.
So you think that triple.
Yeah.
But what if I told you that, yes, I'll triple it, but I'll triple it in 15 to 20 years? You're like, oh, wait a minute. You ain't nodding that head anymore. Yeah. You're like, oh, stop. You just got whiplash. Right? So, so 15 years of returning your money, triple your money, like,
okay.
So cash multiple doesn't take in consideration time value. IRR does.
Okay.
IRR kind of tells you, how efficient are you? If I give you that $100,000, how efficient are you getting that back?
Got it.
Okay, so the IRR is the inferior of all, not necessarily. Hold up. If you have investor A and investor B, they both have $1,000, just $1,700.
Right.
And over 10 years, you're going to give them back. One investor A gets back, maybe gets $100 up front, $60, $40, $80, $10, and then at the very end gets, maybe $2,000 at the end of 10 years.
Okay.
Investor B gives you the same $1,700, $1,400. Let's just say $1,700. All right, don't check my math because this is wrong. I'm just trying to make a point. And they get absolutely nothing for 10 years, but then get maybe something like $20,000 at the end of 10 years. The IRR can be the exact same. It can be a 14% IRR.
Right.
So is IRR actually a clear measure by itself? No. So you need IRR, cash on cash, and you need, your equity multiple to give you a much clearer picture of, if I give you $1,000, one, how quick am I getting it back? Two, are you going to be able to multiply it?
Got it.
And then you get into other returns. When you're talking about other returns, when you're talking more in general terms of an apartment building. Then you get into cap rates and cash on cash returns and things like that. So,
I mean, you said equity multiple. Real quick, if you could just touch on that. So we have our cash on cash return, our IRR, equity multiples. You see that a lot in the investor decks.
Mhm.
Got it. Okay.
Yeah. So it's just now you understand that. Let's not look at just one.
Right.
And IRR is what does it again? It's like, what does it really mean? Everybody nods their head. IRR. Okay, yeah, they keep moving. Right. 18% IRR. Do you really know what that means? Right, so hopefully now you have a better understanding that it means what? Viewers, efficiency. Yeah. How efficient are you at getting my money that I've just given you? How efficient are you? That's what it's really measuring.
Got it. And then you also mentioned discount rate, opportunity cost.
Yes, sir.
Want to explain that a little bit more?
Yeah, it's just everyone has, in order to get a net present value. And again, you're talking about somebody with barely passed math. In order for me to get net present value, in order for me to take and discount future cash flows back to net present value, back to today values, in order to compare apples and oranges and apples and bananas and try to get, compare those, you have to do what is known as net present value. You have to do a discount those future cash flows. In order to discount those future cash flows, you have to begin with a discount rate. So you have to plug that in. And again, for an investor, that could have been 7%. Another guy can be 12%. Another guy. So everybody's going to be a little different. Their opportunity cost is going to be a little different. That's probably helps you understand a little bit more. Their opportunity cost is going to be a little different, but you have to have that opportunity cost and plug that number in order to be able to get, their particular net present value based on those future cash flows.
Love it.
So you can compare a bowling alley against apartment building and any other, asset that you wanted to compare.
That makes sense. So now we're understanding the numbers of these investments. How do we, showcase returns to other investors or to ourselves, whether or not something's a good investment? Let's talk about the due diligence process. So now we've put out the letter of intent, the purchase sale agreement. Take me through this. So now we're looking at things like the rent roll. Let's back this up. What is the due diligence process? We got new investors on here.
Yeah.
What is due diligence?
Due diligence is it's a forensic audit of the investment property.
Okay.
And it's a science in itself. It's a job in itself.
Right.
And it's something that's typically skipped again and not really talked about in depth.
Yep. People are very excited to acquire a property, maybe their first asset.
And they'll look at the leases and they'll look at a rent roll and they'll look at the T12s, on and on, what everyone talks about.
Right. So start paying attention to other people and even evaluate your own process as we move forward. So once again, we're looking at the rent roll. What's included in the rent roll? What is this and why do we need it?
Right. So we're going to look at every aspect of a rent roll, and again, viewers can see what's in a rent roll. But the main thing I'm looking at in a rent roll is when I'm stepping on day one in due diligence, I want to know, and typically it's not me. I'll have two individuals with me, or three, contractor and a maintenance guy.
Okay.
And sometimes four, another property manager, and then a forensic type accountant, somebody that's really good at the bookkeeping that will go through the numbers so we can perform forensic audit. So property manager, they usually go to the leasing office. They're in there. They spend an hour or two inside the leasing office. What they're looking at are the rent rolls and the lease files and all that. And they're going through all of that. And they want to look at the renewals, delinquencies, and things of that. Because they know when I come back from being out in the field and I meet with everyone, those are the things that I want to know. How many renewals do we have? Where are they currently? Because we already know based on our pro forma where we need to get rents to. So how many renewals do we have? How many tenants are delinquent? How many months, weeks, days, hours are they delinquent?
Right.
So these are some of the things I'm looking at. Are all of the vendor contracts matching up with the vendor accounts, the income that shows? Are all the security deposits matching up with the leases? Are all the rents matching up with what actually goes into the bank, right? Statements, so on, so forth. Maintenance, same things. They're doing the due diligence. They're walking these units so I can really understand and have a better idea of payback periods. What does that mean? If I put something in and you can flip through and keep going, Nate, because we're getting to this point. If I can flip through, you can keep going because that's what we talked about. If I'm going through the maintenance, Nate, my maintenance team knows to go through these units and basically build out what it's going to cost to do a couple of things.
Right.
What is it going to cost to maintain some of the main operating components?
Right.
What main operating components may need to be replaced?
Yep.
What does that cost look like? If I have an idea of my demographic and psychographic, because I've done my COTA, I already know where I need to take these units and what I need to do to remodel these units in my value add play. Right. So with that being said, I need to know that if the upgrade is going to cost for new vanities, ceiling fans, what does that cost entail?
Right.
When I put a ceiling fan in, I want to know how much I can get for it.
Okay.
So anything I do to a rental unit, I want to know what I can get for it. So if I put a new ceiling fan and I swap ceiling fans based on demographics and psychographics of that prospect tenant, knowing what I think they want, if I put that $150 ceiling fan in, how much on the base rent can I charge? 15, 35, what is that? Right. And then when I do that and I build out a phase one rehab, and typically you do it in phases. You don't do an entire rehab, because if you miss, your payback period could be longer, or you might not be able to pay back at all because the rents are not going to support the rehab. Right. So you might want to do it in phases, phase 1, 2, and 3. So I do it in phases, because if there's mistakes, or I miss something in the COTA process, we didn't rehab an entire unit and make a mistake. So you might want to just do the ceiling fan and vanity and faucet upgrade package first, right? Okay. You do that. So what's my payback period? We spent $1,100, $1,400 on, $2,000 on these upgrades. What's my payback period? That is what I want the maintenance guys to be able to go through when they come back. That's what I want to know. Where are we? Because see, that's going to coincide with my renewals. Right. Because the first person I'm going to attack are vacancies and renewals, to be able to get those numbers and be able to get those value add phase ones in place. Right. Because that's going to get me to my net operating income injection quicker, because I'm getting those rents up and I'm getting my prospect tenant in. Typically, when I buy a property, this is going to sound harsh, but it is the business. Typically, the current demographic that's in place is the demographic I want to get rid of. Right. Because they're accustomed to paying a certain rent, and I know I'm going to push the rents to a certain point. So let's not even act like, this relationship is going to continue. Now, do they get the best of service? Absolutely. The professionals really know how to do it, and you never know that I'm pushing you out. Right. But I'm basically patting you on the butt and pushing you out at the end of the renewal, because you're not going to be able to afford where it is in our package. Now, do some see what's going on and absolutely love it and can afford to stay? Absolutely. But it's not our, they have to be requalified under our qualifying criteria, rules and regulations under our system. Because now I know my system knows how to select a certain type of demographic or prospect tenant based on my COTA. So I know exactly what I'm putting in these units. When I buy the building, I don't know what those other people did, or even if they had a science, like a method, like I have, that's as in depth as mine. Right. So you don't know what you're inheriting. So that's why that's why it takes stabilization. That's why this is the implementation phase, right? Implementing your systems to be able to change the likeness of this property and make your impression on it. Okay. And then now you're bringing in who you want, based on the amount of renewals. That tells me how quickly I can do these conversions and vacancies. Right. So when I step into a property, I kind of like high vacancies and a ton of renewals, or month-to-month contracts that are already in place that I can, let folks out. It makes it a lot, my project or my implementation plan, it goes along a lot faster that way.
Got it. And so where does the management plan come into all this, as we're
good question. So the management plan, Nate, thank you for reminding. So because just innately, it's right there from the very beginning. The management plan is underway in the COTA process. So when you put a letter of intent out for a property, you need to already be putting together the framework for your management plan. Okay. The management plan and the underwriting go hand in hand. But how many people, by a show of hands and just nod, how many boot camps have you went to in real estate and podcasts? And again, going back to everybody saying the same thing. How many just talk about the underwriting and the market, the value? Well, who's talking about the management plan? Damn it, the underwriting doesn't manage the property on day one. Those are just assumptions. Right. Somebody's got to show up and do the work. It just doesn't run itself. It's not that. This ain't Bitcoin. Right. You don't just drop money in and hope, let it all work itself out some way, somehow. Right. This is multifamily. Somebody's got to show up. Oh, no, give that to the third party property manager. The property manager is the expert. They'll handle that. They'll make you look good. if you select the right one. It's a big if I gave you 500,000. I might slap you upside the head if you told me, hey, I'm just going to hand your money to it. Well, it's the property manager's going to handle everything. You might have to look for my left hook on your blind side. So at the end of the day, the management plan is key. So I'm doing that right alongside the underwriting, Nate, and building that out. So when I step foot on the property on Monday we close, Tuesday we show up. On Tuesday, brother, I've got because the management plan gives way to the operations manual. Okay. The operations manual dictates what goes on day to day, Monday through Sunday at the property. It identifies the work that needs to be done, then tells the users how to perform that work in a consistent manner. Until I get consistency, I can't get profitability. Right. Does that make sense?
That makes sense. Yeah. And so, I mean, inside of the multifamily matrix, you have what's called the Certified Rental Investment Specialist certification. And so what we ask our CRIS members to do is put together a management plan of either a subject property or the current property. This is one of the most comprehensive tools that allows people to demonstrate their ability to manage a property, manage assets, work with investors. And so, it's really thorough. As you look at a management plan, looks something like this. I mean, it doesn't necessarily look like this, but these are all the sections that are within a management plan. Right. And I want to go through just a few of these. So
take them through it, Nate. Yeah, take them through.
Management plan property analysis includes a description and analysis of the property as it currently exists from a physical, managerial, and financial perspective. And it also talks about issues and concerns. Let's talk about that. So physical, managerial, and financial. Let's get into physical. What are some of the physical descriptions? What are we looking for with our property?
I mean, the physical description is going to break down, what it sounds like, the actual physical attributes of the property. You may have an idea where you want to take the property, skating to where you think the puck's going based on your demographics and psychographics that you uncovered in your COTA process and the changes that need to be made. Hence the changes that I needed to make at Park Plaza. Right. I identified structurally what needed to happen, that whole courtyard area needed to turn into an oasis garden. Right. And not just a landfill of people's lawn chairs and bikes and things, what it was when we got there, right? Yeah. So that's kind of understanding what needs to change to the physical description. Did I paint the whole place? No. Did I paint the doors? Right. Yes. Did I paint the gates? Yes. There were certain things that I did. Some might call it putting lipstick on a pig. I called it being cautious and not over improving.
That's correct.
Right. And understanding my market. Yeah. So,
we're going to get into that.
Yeah.
Why we do that. So right now, you're kind of taking note. What is the physical description and what are your concerns? Like you said, what are concerns? So then we move into the management description. What are we talking about within management? Why are we looking at the managerial
within the management plan? Right. You're looking at the structure.
Okay.
So, and this goes back to the JV and joint operating agreement, or even in the investor deck. Yeah. Show me your structure. Okay. Show me, how you plan on operating this property. So this is where you're saying this is the management, this is the hierarchy, this is the organizational chart.
Got it. And it might be just you and you're wearing all these hats, but you need to spell it out.
You got to spell it out. And that's fine. If you know what, and if I see that you spelled it out, I'm confident if it's just you.
Yep.
I'm okay with that.
Yep.
I'm okay with that.
Got it. Then we're looking at the financial description. So what are we looking at in this section?
You're running your numbers, your budget. So you're taking what's in underwriting. And there's always that butting of heads between the underwriting and the asset managers, right? Because underwriters write on hypotheticals, asset managers execute on actually what goes on in the marketplace.
Exactly.
So there's always that, that underwriting. Oh, I think we can get this return, or this is the pref we need, and this is the budget we need. And we're like, no. So I'm always going to lean, honestly, more so even with Chavis Capital. I recruit, as you already know, asset managers who know how to underwrite.
Got it.
So I can eliminate that friction.
Got it.
But turning around some of these larger firms that I had to do with some of the consulting projects, and when we built out the asset management for their firm, I wasn't at liberty to fire people or or build it the way we want. So you have the real estate analyst and the asset management departments being two different departments having to come together. So usually in the financial description, it's talking about the budget, it's talking about the CapEx, it's talking about, exit cap, things of that nature.
Got it. So we would now have the property analysis. Now we're going to look at more so the market analysis. So management plan, market analysis moves from the property itself to the relationship of the property to the surrounding region and neighborhood. We talked about that a little bit. This includes reasoned conclusions about the market rental rates for the subject based on comparable properties. So regional analysis, once again, this isn't guesswork. We're actually diving into the surrounding area, doing the CIOTA process. So let's talk more about that. Once again, why?
Yeah, so it's basically the CIOTA.
Got it.
So now in your management plan, it gets concrete.
Yep.
To, okay, this is how we feel like the prospect tenant's going to react. This is the current employment climate for the prospect tenant, and understand that the management plan should never be fixed. Right. It's fluid. So it changes on a quarterly basis, especially right now during COVID. And you see this new strand of COVID coming out. There might be some shutdowns. Right. So everybody's kind of concerned about what may happen with schools and things of that nature. You got your cavalier, governors and everybody having their own opinions. And let's just be honest, it's more so based on political positioning.
Yeah.
Right. It has really nothing to do with, are we really looking out for people? It's political.
Right.
But this political, it affects you no matter what side you're on. I'm neither Democrat or Republican. I'm an independent. Right. I'm going to always choose what is best for,
right,
how I provide and take care of my family. That's my party, my family. So, but with that being said, the climate and what folks do have a huge impact on whether or not if the schools shut down, bars shut down again. That has a huge impact. How is that going to affect my prospect tenant and my current tenants?
Right.
So things have to change. And when it happened, I had to make changes to the rules and regulations and qualifying criteria. So if you were from the service industry or retail, it was harder to get into my rental units. I was asking for a slightly larger deposit. I was asking for a little bit more, it was a higher hurdle to meet. Why? Because I anticipated you being in some sort of trouble.
Yep.
So I'd rather have a vacant unit than someone in and then saying, hey, I'm not going to pay rent. And, I get to lean on this eviction moratorium. Hell, I'd rather have, 22 vacant units than, 22 occupied, physically occupied units, but not economically occupied.
True.
So that's me on my soapbox for.
No, that makes sense. All right. So we've got the regional analysis, and now we're getting into our neighborhoods once again. So just kind of drilling down. And then we do a comparison grid analysis.
Yep, you compare now against other like properties.
Okay.
Sometimes, like me, I was the one setting the tone. I was always out front. You see this in the Olympics, the analogy, where you always see usually the winner's the one they come from behind.
Right. Very
Very rarely see the one out front from beginning to end. The Usain Bolt type action. The longer races, the 400s and things of that nature. Usually you want the guy come from the middle of the pack and because they're watching and seeing everybody's pace. And sometimes they're dictating the pace a little later on. And then the final corner is when they come on. Right. So, it's how you want to strategize that. For me, I was the Usain Bolt. I was out front from the beginning and I didn't even care. I was not even concerned about looking behind because at this point, like you were saying, the reason why he didn't look behind to everyone until he crossed, until he was 100 yards out, and even then he was just doing it to mock everybody. It's because he was so confident,
right,
and what he was doing, and he felt, he was inferior to everyone else. Without sounding arrogant, that's how I feel when it comes to turning these projects around. All this work that I've done, I already know that we do things better than everybody in the marketplace.
Right.
Now it's about execution. So I'm not really concerned about everyone in my own philosophy. I set the market rent, as you well know, when we got there, rent schedules were right around 850, 860, 875.
Right.
I pushed them to 910, 920. Now for those units less than 400 square foot, we're getting $1,400 in rents.
Yeah, it's phenomenal.
In 4 years.
Right. Well, that leads
in
me
October, coming on 4 years.
That leads me to our next section. So it's kind of a summary and conclusions area. So this is analysis of alternatives. Within the management plan, you're providing specific alternative courses of action for the property that are identified and tested. These alternatives are developed to address the issues and concerns of the property in order to meet ownership objectives. So your objective was to take that from that 875 up to over $1,000 in rents. When we're looking at things like issues and concerns, we've already gone through our analysis, our market analysis, our property analysis. and we're just putting concerns on there that already exist. We're not adding anything new. And so when we're talking about alternative courses of action, you had showed there was a kind of a spreadsheet of all the different changes you could make to the property. Why are we looking at alternative actions, including one of just
calculations, strategy,
right?
Chess, not checkers.
Okay.
Again, and ask yourself, if you're studying, you're learning, and you're talking to other investors, ask for this. Forget all the small talk.
Right.
Ask for the management plan. Go right for the jugular. Ask the investor, do you have a management plan that I can take a look at?
It's going to sound like that.
And it's going to sound quiet like that, like crickets. Yeah, for the most part, exactly. It's going to sound exactly like that, because this is how you separate yourself.
Right.
You know, this is where it's won and lost. This is where it's won and lost. Now, how many people are really saying, provide me with 4 or 5 solutions to upping the rent into this package that you created? Provide me 4 or 5 tested solutions against the other competitors in the market,
right?
And go from there.
Right. And so, think about this. I mean, as you guys are getting approached for syndication opportunities, you're putting $100,000 in with 10 other people, raising millions of dollars, and the person that you're investing with doesn't have a plan, doesn't really have what it takes, but they seem credible. Think about these things as you're looking at your own properties. As people are approaching you with opportunities, you really want to start scrutinizing them and see that they're qualified. Just because they can raise money doesn't mean that they're necessarily qualified to give you solid returns or even any return whatsoever. So I want to I mean, we're kind of running out of time here, but we looked at the alternative courses of action. We looked at the management plan. Let's take a look at, you want to look at underwriting?
Yeah, I mean, I think we kind of I mean, I think we've ran out of our allotted time. But again, it goes to show you'll probably have to come back if you want to just quickly show exactly what we've missed. But the sections, I feel like we gave a good overview without having to blow everybody's mind.
Absolutely. So I mean, we
get to some questions and
got things like revenue drivers for the subject property, our exit assumptions.
Right.
We go into underwriting. What is underwriting? Our underwriting standards, things of that nature, the underwriting process as well.
Yes, sir. And we can always come back and touch on these. Unfortunately, on Saturdays, it's my family time, so I've got to get out of the studio and get to the wife and kids. But
there's a lot of things that are not, I wouldn't say more important than underwriting, but deeper than underwriting. I think we all
the whole thing is deeper than underwriting just in itself.
We've heard a lot of underwriting, whether we have a proper
right, exactly. You can YouTube that.
Yeah, we wanted to get into a lot of the potatoes behind. Okay, once you acquire the asset, you've got to perform.
You got to perform.
So love to open up the floor for questions, and just have a Q&A.
Sounds good. Thank you, Nathan and Bryan, though. I took a few notes here. There's a lot of golden nuggets, Bryan, that you put it together. I think one thing that for sure that for me that hit me in the nail is just like share business plan with property management. How many times it's a simple statement that a lot of people forget, that you are buying a property and you're trying to repositioning, not the property manager, because their job is just basically managing property, right? Right. Another thing's also like legal structure. Again, some simple thing that like as simple as just keeping up the meeting minutes to keep it in compliance. Otherwise, you're going to be exposed, from the legal lawsuit perspective. Your brand, people perception matters, especially about you. What you present in social media, who you are, that's who you are. That's the branding that you bring it out. I mean, if you keep flashing out, bling bling and thing like that unnecessarily, and then people I think like, hey, wait a minute, are you a scammer or are you an investor? That kind of, are you a business person, kind of thing. And one thing I really like is just money always follows skills, because a lot of people, especially in this market right now, to be honest, though, when cap rate is compressing a lot and hot market everywhere, anything that you buy today, you can just flip it the next day and you make some money. But the true operator is really need to keep sharpening your skill, because only by then you set the tone differently about your brand, your person, the way you operate, then the money will follow that way, follow your skill. You know, and I love, by the way you explain about IRR. I think I find it, very, very efficient. You're talking about efficiency of the cash flow returning to you. I think I like that a lot. I'm gonna steal that from you, Bryan. For that too.
All right, just make sure you credit me.
There you go. Yeah, Bryan Chavis said. Yeah, there you go.
Thank you.
Yeah. All right. With that, I'm gonna open up for a couple of questions. If anybody have questions to Bryan.
All right,
I think everybody. I think everybody got overwhelmed, and then not overwhelmed, but everybody digesting. You got a lot of information in there, though. I myself, in this business, but still, I'm picking up a lot of golden nuggets. So thank you, Bryan and Nathan, though, for facilitating this.
Our pleasure.
It's our pleasure.
Yep.
I don't have a question.
Yeah, I have.
Comment. Hi, my name is Nona Pickner, and I'm also here in California. Met with Mercy and other people like Karen and Greg, and I have been a part of Bryan Chavis community for more than a year, and it's absolutely priceless. The programs that it offers, all the guidelines, coaching, documentations, questions, answers, teaching. It's absolutely amazing, and it's useful for people who just want to invest even passively, to people who want actively invest, people who want to manage, asset manage or property manage, create their companies. So you just have every single point that can be in existence for industry we are all exploring and learning from using Bryan's system. So I really highly recommend Bryan, and hopefully we can bring him to California soon to present in person.
Yes, I'm looking forward to coming to Cali. I'm planning. I definitely want to plan the trip. So thank you, Nona. I greatly appreciate it. Yes, we love having you as a proud member. And yeah, when we maybe we can finish the presentation and in person. So I would love to visit you in California.
That'll be great. Let us know. I think we got one. All right. I think I got one question though. I think Maya, you have a question, sir?
Yes, I have a question. Thank you so much for your presentation, Bryan. That's very good and deep knowledge. Okay, if you already identify where you want to invest, right? First, after that, what do you do? You set up LLC, and then open the bank, and then make an offer first, or you set up the LLC first? How you do it, from start to beginning to end, like step by step?
Yeah, I mean, and that's a lot to bite off, but I'll try to cliff note it for you and just give you the bullet points. So if I was starting out, I probably would go ahead and season my LLC as quickly as possible. Even if I wasn't going to buy anything in the next year or so, and I'm just using this first 6 months to 9 months. First thing I do is I budget 6 to 9 months for true education and training, period, in the story. Whether that's go to university, go get you a degree. I'm talking true education and training and understanding how to manage and operate properties. 6 to 9 months, I'm budgeting for that. During that 6 to 9 months, I'm going to set up an LLC, create an LLC. I'll probably set up two. One LLC that's going to handle my property management. One LLC that's going to be my single, my umbrella. And then once I located a project, then I will create an SPE, single purpose entity, to hand that over from the umbrella to the SPE once acquisitions has actually happened. But the reason why I'm doing that is to be able to season it and have a relationship with the bank, and also show that these LLCs are not just newly minted LLCs, that they've kind of been in business for a while. So that no matter what, that does help. You don't think it does, but it helps to have seasoned LLCs. And if there's ability to put money in some of those accounts to season those as well, it helps with your bank, helps with establishing that EIN and building that business credit. as well. That's a whole different class that Nathan can teach you guys how to take everything out of your personal and start putting things into your business. So, that's kind of how I would start. But the most important thing is to start with that 6 to 9 month budget for training and education and building your foundation there. That's key. Because other than that, you're guessing and you're depending and hopes and dreams, and you're depending on the market to really carry what it is you do.
Oh, you said we have to open LLC, like 2 LLC or
I
only one?
would personally. Again, I don't really understand what your what your goals are. So we're just spitballing here. You need to speak with your accountant and your attorney. But for me personally, yes. In the beginning, and when you start with most of my clients that start at the beginning, you're creating you're creating your foundation, and that foundation, that framework is a 6 to 9 month budget for education and training. And during that time period is when you want to immediately start the LLC, one for your umbrella and the other for your property management. If you've identified a property, then under the property management, you open up 2 accounts, one security deposit account, one operating account where the rents go. Security deposit account or trust account is where the security deposits go. Then on the umbrella entity, you open up an operating account and a savings account, and then the rents and your income goes there and pushes up from there. Property management has 2 accounts. Again, the operations and security deposit. Do not commingle those two between the two, because if you're sued in property management, and it's attached to the single or the umbrella entity, or at that time the single purpose entity, I can come after both. So be careful that the accounts don't commingle.
Oh, you have to set up 2 LLC, one for property management and one for the umbrella.
I didn't say you had to. Right? I did. Be careful. I didn't say you had to.
Okay.
That's what I do.
Okay.
You can go out there butt naked and open up. I mean, butt naked, not literally butt naked. I meant butt naked, like, with no corporate veil protecting you, and do it as a sole proprietor. I mean, the law, no one's going to tell you that you have to do one thing or the other, but the educated and the well-trained do, is what I'm saying. So you don't have to do anything that I just said.
Okay, got it. And then after you open the LLC, then you start looking for the property.
Correct. Well, again, education and training is the most. That's the one I want to hear you repeat the most.
Okay.
All of you guys love to go to a 3-day boot camp or a 2-month boot camp or listen to a few podcasts, and everybody thinks that they can jump from high school into the NBA. And that's literally what you all are trying to do. You're a weekend golfer and you think you can play on the PGA Tour. You're playing against professionals at the highest level, and you got to recognize that. Stop thinking that allowing and benefiting from the market carrying you. You want to know at the end of the day when you go to sleep that fundamentals are carrying you and not the market. And even these gurus that you guys lean so heavily on and love so much, most of these guys have no clue about operations. They can tell you 7 days a week, twice on Sunday, how to underwrite it and do all those fancy things that sell books and CDs and software and coaching. But when it comes to the operations, can't tell you a damn thing. So just understand that that's the most important thing, is understanding the foundation, the principles of this business, understanding how to navigate acquisition, implementation, stabilization, growth, and exit strategy. When you can navigate all those stages, then talk to me about being ready to find a property.
Do you know which school or maybe course that we can attend?
No, I don't.
Oh, you don't? Oh, okay.
I do.
Thank you so much.
Bryan, know what course you have to attend. You have to attend Bryan Chavis course.
Yeah.
I wasn't gonna say that. No, if she ain't figured that out, I was gonna let it just fly right over her.
So
head.
I want to say real quick.
Okay.
It's gonna.
Thank you.
It's very important to partner up with the right training programs. Multifamilymatrix.com is a place where we provide education and training. What you guys are doing at San Francisco Multifamily and More, that's extremely important part of your investor journey. You guys want to continually stay plugged in. What we hope to see is a strong partnership between SF M&M and Multifamily Matrix, so that we can provide education and training to you guys to make sure that you guys are protected. You guys have access to legal counsel, all kinds of things and continually stay plugged in with Hindra and his crew. You know, that networking and business building is going to be so valuable. We just want to help provide an additional, educational support system to you guys.
Yeah. Well, thank you, Nathan, for bringing that down. A lot of people forget that it's literally a team sport, right? I mean, you got to plug into the right community with the right team. This is a platform that being used to not only educate, but this is only like an entry level of education. And eventually you need to be vested in the education that's, in the program, coaching program, mentorship, and as well as the community itself. And then that's how you grow and scale in this business. It's not just like buying and praying like
Right.
a lot of people are doing, unfortunately.
Mhm.
Well, thank you again for the time, Bryan, Nathan, and
Welcome.
team. Before we adjourn, I'm gonna give you the announcement for the upcoming event you're gonna have. On 2 weeks from today, we're gonna have our friend Vinny Chopra talking about silver tsunami prediction and taking down a senior living community. I know that a lot of people see there's a trend that we want to go to senior housing. So Vinny gonna be speaking about senior housing in this case here. He's a great friend of ours, and me and Mercy. Looking forward to see your participation in 2 weeks with Vinny Chopra coming here. If you have any interest in senior housing, this is gonna be an event you don't want to miss. Thank you again, everyone, for coming, and especially for those who are in East Coast, spending your Saturday with us, and we'll see you in 2 weeks. Have a great day, everyone.
Thank you so
Okay,
much.
everybody. Thank you.
You guys.